Welcome to the next episode of Blockrevision. Today we are back after a longer break and finally clearing backlogs. After 1 month of our absence, we will start producing daily content every time when it's working day, quarter to 9 a.m. East time. Blockrevision will be with you once again. So I'm glad you are back. Thank you very much for tuning in, and without any further ado, let's get straight into the intro. So at first let's have a look at what happened during a Fed meeting that took place previous week. I will jump straight ahead to that presentation and explain what we were counting on and what market discounted right after. So at first, what's worth noticing was that Fed hiked of 0.75 points. So that was the amount that was kind of expected by the market participants. Right now, we don't find there's a chance for Fed pivot. Some of journalists were writing that the market expects even higher interest rates, but 0.75 points was what the majority of the market has counted on, and that came to fruition. So, as we could hear, the Fed statement was kind of dovish at first, but right after, Jeremy Powell told that Fed is obliged to take interest rate hike by that amount for a longer period of time than a market previously expected. It literally sends a clear message to the market that no matter the pace right now, more important is how the rates can rise eventually. So we can find that recently we've been battling with inflation. This inflation gauge has been high, and there is nowhere near of an end to this battle. Recently we also have a release been made by US side release of stocks of oil barrels due to increasing the this fight for lower prices, at least in the energetic side. Right after midterm elections, that narration may end, and we may find that we will start releasing. We will start to stop this tendency even going further, as we haven't seen such a pace of stock reduction in our history. That tendency needs to get stopped in order to make the US not prone to this shock of demand on the oil market, and in order to gain resiliency. What's next? So United States midterm election right now pointing that the markets giving the bigger chance to win to Republicans. US elections are, however, somewhat overshadowed by market's performance, as recently we had many important events that were kind of hitting the market. However, in order to judge what the outcome of this election might be for the markets. It's a very difficult one, as I would say neither one nor the other side has any topics that may ignite the market to upwards or downward side. There's not much of a very hot topics that markets may orbitate around and might be scared. There's always some kind of anxiety in terms of which side eventually win, but this time I would say there's more about the global, the macro situation that literally tightening this supply or demand side rather than any of the governing party. In terms of talking over the inflation problems, right now we may be looking at the problems with VICO value index that recently, fortunately for the bears and for the possible buyers, is dropping. This bubble that had been pumped after pandemic outbreak right now is getting burst as this demand side is stepping out. So that's very important component of the total inflationary indexes that I pointed recently, 8.2%. 8.2% of year-over-year inflation gauge recent month. So this component eventually easing the ratings, and that may bring some hope for lower ratings of inflation in December. We had also during our time of this very interesting element of tracking what the markets are living for. This ban being introduced by Biden, that introducing the resignation from jobs for Chinese tech companies to US citizens, and it literally means that this cheap market might be in somewhat trouble. Recently we've had this throughout recent couple of years, this globalizations aspect that has worked in somewhat de-inflationary path. However, after such a draconian measures have been introduced by US in terms of this sector, we may find that the technological aspect of the economy may get even more shaky than it was before. This breaking of supply chains may even worsen, and that's nothing about getting out of this crisis pointing right here. What we got next, Europe's doubtful projections. So recently we've had that ECB, the European Central Bank, has introduced the new economical model, inside of which we don't find the requirement to introduce a hike of interest rates to similar level as it was in the Fed side. Even with ECB trying to handle with even higher and historically the highest inflation rate ever been noted, those projections that have been made by economists of European Central Bank are not pointing at the necessity to hike that high. So many analysts out of the European Central Bank claiming that those measurements that ECB is trying to reach for are not sufficient. Some members are very skeptical about that model. And what about this premise that recently been introduced that the QT in Europe will eventually be necessary? That phenomenon that's been foretold for that long period of time. So undoubtedly, that will be a very difficult for the markets. But what about the credibility of ECB? If they foretelling one thing and introducing another, what does it mean for European area at all? So that's kind of a cloudy days over that region. Let's jump to the next. Also, Bank of England that recently has introduced some projection recessions that are about to hit the market. So even Bank of England cannot really avoid the word recession. Macro data is still worsening over there. Bank of England has during this first half of October ended emergency bond buying program, but is deciding to tax cut plans to cancel. And the fiscal plan is to be presented at the end of the month. That was around the October. So there are some of the government. There are some intentions to strongly change the approach to the mini budget. They cannot really sweep away this this necessity of quantitative easing process in this or that way, that it's returning like a boomerang. When something starts to crack, as it was during the problems with the pension funds that were that were suffering from lack of liquidity, right now we need to fix another hole, and those holes unfortunately are starting to break one after another, and those cracks are getting larger. That's why the Bank of England has a very difficult time ahead, and I'm not really the one of being envious of those that are governing right now. Let's jump to market outlook, however, right now, and the question is right now, what may improve the sentiment? Already spoke to that extent. S&P 500 index average performance in US midterm election years has been as this one throughout three first quarters of that average year, spite of what happened during 2018, where we had kind of a negative end of a year right after midterm elections, but the market claims this time might be different, and this time might be as statistical measure shows. So what may improve the sentiment? Fortunately for the sake of the bulls, the probability looking like the last quarter of this year might be much better. Markets don't like uncertainty. It seems to apply here. At the beginning of the year, there is less certainty about the outcome of the elections and their impact on future policy changes. Right now, after finally people going to the polls and closing the results, and where this moment of the winners been announced to this midterm elections been eventually found, we may have to be seen much more positivity, at least taking the approach of that side. So this time there are some projections for the last quarter, but what the future will tell us is yet to be announced. Earnings projection still fine, so the market was really afraid of this earnings season. However, that was one that haven't brought that problems that been previously projected. Earnings are still earnings projections are still fine, as that nowhere near to what happened during the GFC, where those projections has dropped by around 50%. This time, this tweak gets us to just around a bit lower than 10% to a majority of stocks. That's why the expectations are still very, very high. But on the other hand, S&P 500 is already in earnings recession, if not counting energy sector. So this energy sector is definitely upgrading the whole spectrum of the earnings gauges, but something that may also be this destruction of demand might be still yet to be seen on those prognoses. So that was earnings projections. S&P 500 P ratio, looking at the broader aspect, right now is showing that we are somewhere around 15 and 19 points, and there might be a room to slide to even lower, around this lower boundary of 15, where it was back during 2011-2012, where we had this difficult time of recovery after GFC. So this time we may get to the same territory, but that's just my assumption. All right, so market mover section, and we need to catch up many elements out of this. So without any further ado, let's jump straight into this, and that's a market calendar. Let's jump into the beginning, or rather the first half of October, where we stopped transmitting new episodes. So on 10th of October we had consumer confidence change, and that was assuming that we are somewhere around this GFC and pandemic outbreak levels of around 80s. We are still over those very shaky low 90s times. However, there's nothing to brag about. I do expect the Australia consumer confidence may get a bit better as it's the economy based on resources. That's why it's not suffering from this broken supply chains to that extent. However, I don't find that a V-shaped recovery might get here a room, especially with those destruction of demand might still be somewhere occurring next few months. So Australia consumer confidence is still in the negative territory. Right now we are heading into another sector, and that's another date that was the 12th of October. PPI out of the US right now is showing that we are recovering, and that's positivity being seen recently, but we still are maintaining inside of this consolidation of minus 0.5 and 0.5, and that's nowhere here from a further stabilization rather than much of the robust period in the economy to be announced. Recently, cost of services rose, as well as travel accommodation services jumping 6.4%, but there's still many questions yet to be answered in terms of what the future of that gauges may look like. Heading next to another date that was 13th of October, we had inflation rate out of the US. As I told already, it was 8.2% as forecasted. That was giving us a chance for plateauing this inflation around these levels. Fortunately for that type of curve, we are right now possibly near flattening and maybe reversing next quarter or during the first half of 2023. On 14th of October, we had retail sales out of the US. That's the gauge that kind of helping the demand side from collapsing. Retail sales is still somewhere around the neutral levels. On 18th of October, we had German sentiment index, and it's definitely one to worry about. We are below minus 50 levels, below those pandemic outbreak terms, and we are right now hitting this trough of global financial crisis. So there is still a long way ahead of German economy to recover. On 19th of October, we had housing starts in the US that right now sector that's due to its mortgage rates is not really performing well, and there's more expectations to correcting it further. So that's of the US that date. On Thursday, however, out of the US we had existing home sales that was as expected, and consumer confidence out of the UK that is collapsing and getting lower and lower every single time. So UK is definitely the one economy that has any real trouble, and that will be very interesting to watch how they will tackle with all the things that are really storming the economy over. Retail sales out of the Canada, it was something that we had on Friday that was better than expected. Retail sales out of the UK, however, has disappointed many. On 24th of October, we had many PMIs out of the euro area that are below 50-ish levels, whereas the US gauges also has drawn down to 49.9 and right now revolving around this neutral levels, possibly turning to a bigger drop next months. On 25th of October, we had inflation rate out of the Australia that was higher than forecasted. That's why giving the room for RBA to hike interest rates even further. On 26th, we had Bank of Canada interest rate decision, and that surprisingly raised interest rate by 0.5, not 0.75 what a market expected. So that was interesting. That's interesting, and that also gave a hope to the market that Fed might not be as severe as it was, but we've already introduced that they decided to take it by 0.75. ECB interest rate decision, that was by 0.75 as forecasted, giving the euro area kind of catalyst to I would say strengthen its currency. Finally, saying that what we got there at the end of the October left, personal income out of the US was higher than expected. Inflation rate of the Germany still around similar levels of 10 and even 10.4 10.4%. What we got right of next, we had on 31st of October inflation rate out of the whole euro area that already spoken, 10.7% GDP growth rate for the whole territory that was at 2.1%. On November 1st November of this year, we had PMIs out of the US that are still around 50-ish levels, that are not a presage for the recession yet, but this slide, as you can find, this steep slide of this gauge is eventually showing that we may be somewhere at the brink of the possible bit more difficult time for the country. On 2nd of October of November, we had been going through ADP that were still strong, and Fed interest rate decision that I've already discussed over. If you haven't checked it, just rewind to somewhere around the beginning of the episode. If you haven't noticed, I have right below my window the field with a chat, so if you want to share your point of view during the transmission, let's do it, and I will try to answer as soon as possible. So getting back to the end of this economic calendar, we had on 3rd of November Bank of England interest rate decision that was has been risen by 0.75%. Balance of trade, maybe for Canada, let's talk this quickly, is rising, whereas for the US has, after this V-shaped recovery, is trying to recover. ISM non-manufacturing PMI, this however is better than just the one I've mentioned, that was manufacturing. So the non-manufacturing is much better than manufacturing. And on Friday we had recently unemployment rate out of the Canada that is still around expectations, and non-farm payrolls that also was better than expected. So we still have a kind of a room to hike interest rates further. On the Canadian side, we had PMIs that after this very nice gauge of 59 has dropped to 50ish. This week, at first we have consumer confidence index. I'll maybe switch it to this week. And we had consumer confidence of Australia to watch right after. On Wednesday we have some Fed members' speeches. That's also worth listening. On Thursday we have inflation rate, very important for the US in order to verify in which of the two sides we are going to in terms of inflation, and whether the Fed will have its more hawkish or dovish stance at the next FOMC meeting. So that's it. That's it out of this. Next week we have also the GDP out of the Great Britain, but it's of the lesser impact to the markets. So I would like to show you right now very important element that is the end of the earnings season. So we'll jump to I need to just switch quickly to earnings season as it's backward, and to the first slide. On market mover side, we had earnings season, and we were going through many technological earnings publication, instead of which many of them were average, below expectations, but not as bad as many of the bears has counted on. Samsung, the world's largest manufacturer of memory chips, recorded a 32% decrease in operating revenues, whereas Micron recorded a decrease in revenues and announced revenues lower by $1 billion than expected for the current quarter. And also adding up to this, Micron announced a decline in revenues from the data center segment, where also expectations were high. And so AMD, let's talk over this one. AMD corrected their revenue forecast by the same amount as Micron. Apple's disappointment on the sales side of phone, even after this sales record been achieved. Amazon with poor revenue projection. Meta rising costs and lowering is already extended in time. So let's jump quickly to some charts, and we have right here SPX. Let's maybe, sorry for the amount of lines you need to get through. So I will enlarge the window. And right here, that's the VIX. VIX recently has been sold off. We can find that this fear and greed index right now are pointing that we are reverting the risk on the markets, and that's why many of the indexes has rebounded to large extent. The biggest winner was definitely the Dow Jones, which companies has published much better forecasts than the technological sector companies. So the DJI have its 5 minutes and performing much better than SPX and US 100. In terms of the DJI, as we have already been started after this very strong demand candle, we had this impulse that stopped us right somewhere around the previous resistances, and the decisive moment will be right after crossing through this downward trend line. If we manage to get over this 33,200s, that will be a clear path, nearly clear path to move upwards further. But right now we need to show the strength at this decisive moment. On S&P 500, if we just erase many of those blurring the inside lines, we have a rebound out of the recent highs at the 3,500s, and we are right now struggling with bears at this level. But after crossing 3,900s, we'll have a clear path to around 4,300. So right now, for many of the indexes, I would say, aside of US 100, that's right now the weakest, many of the indexes should have its rebound moment, as the seasonality is putting this in favor. However, we are still awaiting for the results of the midterm elections that take place on Tuesday. Right after this, the viewpoint on the indexes might be clearer, and the projections may get even worse if these bulls will turn up for longer. So right now we are struggling with two very strong sides. Either bears or bulls have some words to say, and we need to be very cautious in terms of our investment decisions. In terms of trade ideas and the opportunities I do find on the market, I will tell you tomorrow, 8:45 a.m. is time, as always. So thank you very much today for tuning in. We have just gone through a very important element of discussing over recent time. That was a longer episode. Tomorrow will be shortened, definitely. And thank you for staying with us, and see you.